Hey everyone, welcome to Valley Green, and I hope you're excited for today's video. Today I'm going to talk about option trades that you can utilize if you have a small account and you're new to option trading. If throughout the video you found value and you learned something new, I would greatly appreciate it if you could like and subscribe. It's very simple and very easy. Also, feel free to comment down below any stocks or other options you may want me to cover or any questions you may have. Now, jumping in. Let's assume you are new at option trading and you have a smaller account. So you may be just getting started and not really know where to start. So the first option strategy that I would recommend is selling cash secured puts. And now what does that mean? That effectively means you are opening a trade where you are willing to purchase 100 shares of a stock for selling an option. So what's going to happen is if you're going to sell an option, you're going to collect a premium. And then you're potentially going to have to purchase that stock at a lower price point of whatever strike price you selected. So I'll go into an example of that because I learned from examples. That's how I got started. I had to practice, go through the examples, and then I would see how it would turn out. So I'll go through that with Palantir. Now the reason I'm choosing Palantir is just as an example is because it's a smaller stock from a stock price perspective. So if you were to sell a cash secured put on Palantir, it would only require roughly $1,500, which is very different than if you were selling a cash secured put on Tesla, for say, because that would require closer to $27,000, $28,000. So very different size stock from a price point perspective. So that's why I'm using Palantir as the first example. What would I do if I was new to trading and had a smaller account? I would start with Palantir just as an example, or a similar company at this price point, and practice with selling cash secured puts. Now remember, I only want to do this on stocks I am willing to purchase. On Robinhood, we're going to jump to the trade options selection. So if you're new to option trading, this may be very new to you. This is what this looks like. So effectively, what's broken down here is you're going to have your strike price. So that's really important. Your ask price, which is effectively the premium or credit that you're going to be getting for whatever trade you go into. The expiration date on the top, and then whether you're buying or selling or call or put. So for the cash secured put, you are selling a put. So I'm going to select that up here at the top. And then you need to look at the expiration date. For this example, I'm just going to go August 18th. That's about the third week of the month, 40 days out. Now what's going to happen and what does this cash secured put look like? So you're going to choose a strike price. You're going to choose the stock price pretty much, where you'd be willing to purchase 100 shares of Palantir in this example, or whatever stock you are selling a cash secured put on. For this example, I'm going to go with the 13 strike. So I'm going to select the 13 and I'm going to click the plus right here. And now you can see over here, cash secured put popped up. It says selling 13 and 48 cents. So what this is saying is it's a credit of 48 cents per share of the contract. So selling a cash secured put right now, this is selling one. So what's happening is you're getting 48 cents per share of the contract. So you would get $48 because there are 100 shares in a contract. Looking at some of the data points over here for Palantir, you can see the delta's 0.2, so that's fairly conservative, and the implied volatility is actually pretty high, 73%. So what's happening here is you are selling this option, so you're going to collect this. This goes into your bank account today, or your trading account, for example, Robinhood in this case. If you sold this, you would collect $48 today, and then you would have an option open. It'd be sitting out there in your account until August 18th. Now, a couple things could happen. If the stock price goes to 10, let's say, you would be put 100 shares of Palantir at $13. So there is a risk that you could be assigned the stock at a lower price than the strike that you're going to purchase it at, and it could go all the way down to zero. So that's why you want to sell cash secured puts on stocks you'd be willing to hold for the long term. So again, this is just an example. You have to identify what those stocks are for you, and notice that the premium or credit you'll collect, it will definitely vary by stock, by industry, and depending on the type of volatility that stock sees, that can also definitely influence what the credit or premium looks like. The other scenario, if this goes in your favor, is let's say the stock on August 18th is $14. Then what's going to happen is this option is going to expire worthless. That means nothing's going to happen. this premium, this credit is already put in your account today, so you don't have to worry about anything. The option expires, and then you could just go sell another cash secured put on Palantir or whatever stock another month from now, or you could do it 2 weeks from now. So that's kind of the first strategy and approach I would take if I was new to option trading and new to selling cash secured puts. I would look for those stocks trading around $10, $15, high quality companies. I would definitely look into that if I was looking to sell cash secured puts. If you sold a couple cash secured puts before and you have a little bit of experience with it, you could move to something a little bit more complex, which is trading put credit spreads. What I love about put credit spreads is it's effectively selling a cash secured put, but you can do it on a stock like Tesla. For example, I'll walk through how to set it up and what it looks like. I've definitely covered Tesla in some other videos. Feel free to check those out. So I'll just walk through Tesla as an example. You may be asking right now, how am I going to sell a cash secured put on Tesla if it's trading at $275? I don't have $27,000 in my account. That's totally fine. This strategy is very friendly for small accounts, and it can be used on every stock out there that, may be outside your threshold of selling a normal cash secured put on. So let's take a look at what's going to happen. I'm going to select sell. I'm going to select put. So, right off the bat, it is going to look like selling a cash secured put. I'm going to close this, and as you can see, select August 18th, 40 days out. So, right off the bat, let's say I want to look at the 250. You may be thinking, well, I don't have 25 grand to sell a cash secured put, and that's okay. What you're going to do is you're going to create a second option on this trade that's effectively going to protect yourself. So you're going to buy an option a leg lower than the one that you sold. So I'm going to buy the 245. So now the total credit is $125, and you're putting up $500 of collateral. And you may be asking, what do you mean $500? So the $500 of collateral is effectively the spread between the two strike prices that you're selling, this 250, and that you're buying the 245. So the difference is 5 points. One contract, 100 shares, 5 points, it's $500 that you're effectively putting up as collateral. Now, what's amazing about this strategy is the overall percentage of return is going to be much more substantial than if you were just selling a cash secured put. Ideally, with a put credit spread, it's going to expire worthless, and that Tesla will be, above the 250 price point. Similar to if we were selling a cash secured put, we would want the stock price to be above the strike that we were selling it at. From this perspective, this is over a 20% return for this trade, which is pretty phenomenal. But you have to keep in mind, these strike prices that I chose as an example are fairly close relatively to where Tesla's trading. It's 25 points off, but for Tesla, a 10% increase or decrease is not uncommon by any means. With Tesla, you have to, look at the strike prices, figure out what kind of risk and reward you're looking for, and the kind of premium that you're looking to achieve. So the put credit spread strategy is very similar to selling a cash secured put. It just is a little bit more complex given it adds another leg to it. Now I want to look at another example and walk you through what trading a put credit spread on Airbnb is going to look like. I want to choose another stock that's a little bit cheaper than Tesla, but still probably outside the bounds of selling a cash secured put if you have a smaller trading account. So in Robinhood, I'm going to go to trade options. I'm going to change the expiration date just like I did on all the other ones. And then I'm going to go to sell put. So, it's going to assume initially we're selling a cash secured put. So let's take a look at this example. Let's go to the 120. If I select the 120, you can see implied volatility is 48%, so much lower than Tesla, but still pretty solid. The delta is 0.26, so in this case, it's a little more aggressive, but still a little bit conservative. If you were trying to sell a cash secured put on Airbnb for 120, you would need $12,000 of collateral. That's a pretty significant amount of money, and your return would be $360. Now, again, cash secured puts can be amazing if you want to purchase stock at a much lower price point, but for this example, I'm going to show you the put credit spread. So now, what I'm going to do is I'm going to go to buy. I'm going to change that up in the top left, and I'm going to choose a leg lower. So here you can see I'm selling the 120 put, and now I'm buying the 115 put. So I'm going a leg lower, and I'm protecting myself by buying it. So now what's happening is I'm putting up $500 of collateral and I'm collecting 123. So this is very similar to the Tesla put credit spread and the percentage return. Now note, the market's not open, so the bid ask, total credit, and expected P&L, it's not lining up because the market's not open. This video is being recorded over the weekend, so keep that in mind. But this is still just an overview of exactly how you could do it if the market was open and where to look in Robinhood and kind of what the percent returns could look like at these strike prices and at the current premiums. Now, if you want to be more conservative, you could definitely set this up a little bit differently. You can go much lower, let's say 100, which is fairly low, given Airbnb is trading at 130, and then you can go buy, and you can go to the 95. So here you would only collect $16, but you're putting up 500, so that's 3% return in 1 month's time frame if you were just doing one of these and had $500 of collateral to do this trade. But you have to consider what risk and what type of reward you're looking for when trading options. There are a lot of risk involved, so definitely make sure you understand the basic mechanics of it, and that's exactly why I'm covering kind of the key steps and how I would approach it if I were new to option trading and new to selling cash secured puts. Now the last stock I want to cover an example, just to give you another overview of how it works, is on Square Block. So Square has a lot of potential to move upward fairly soon, in my opinion. It's kind of hovering at this lower range for the past year, and I think there's a lot of momentum and opportunity for Square. So selling a put, if you have $6,000, $7,000 on Block and you're willing to hold it for the long term, could be amazing. But again, if you have a small account, the put credit spread is an amazing strategy to get started in trading options. So let's take a look at Square. I'm going to go to put up in the top left. I'm going to click sell, and I'm going to change the expiration date again, going to August 18th, 40 days out, just for this example. And now let's see what's going to happen if we select the 60. So let's look at the 60, Greek about 0.23, and implied volatility 58%, so fairly good implied volatility, so that'll help the premium. So here you can see if you were to sell a normal cash secured put on Block, on Square, you could collect $200 for putting up $6,000 of collateral. That's roughly a 3-4% return. If you don't have $6,000 of collateral, I'm going to show you how to do the put credit spread for Square. Now you select buy, so you change it to buy. You choose a leg lower. So for this example, let's go to 55. Here, what's going to happen is you're going to have a total credit of about $100. This also is about a 20% return if you're putting up $500 of collateral. So here you can see the 60 to the 55, that's 5 points. So that's $500 of collateral. These are the key steps of how you would set up the cash secured put. And then if you want to do the put credit spread because you have a much smaller account, these are the kind of the key steps and key things to look at in how you would set it up. Now you have to decide what stock you want to trade the put credit spreads on and kind of what strikes and how far away from the current stock price that you'd want to trade given the type of risk and reward you're looking for. So if you found some value in this video, I would greatly appreciate it if you could like and subscribe. Hope you have an awesome one and look forward to the next video.